Hi everyone, Iftekhar here from CLiK Trading, and welcome to this week's Market Roundup. Now, if you only looked at the S&P 500 this week, you might think not much happened. It finished slightly higher and stayed around record levels. But underneath the surface, there was actually quite a lot going on. Inflation cooled, oil surged, smaller US companies outperformed some of the technology giants, Bitcoin moved lower, and by Friday, we had another question to think about. Is the US consumer starting to slow down? So let's have a look at what actually mattered this week, and more importantly, what we can learn from it as traders. Let's start with the bigger picture. The S&P gained around 0.4%. The Nasdaq was just positive, while the Dow fell 0.6%. Nothing particularly dramatic there. But look at the Russell 2000, up around 1.1%. And that's interesting because while smaller companies were performing well, several of the big technology names were actually falling. Then, away from equities, crude oil gained around 5% from Monday's open to Friday's close, while Bitcoin fell more than 3%. So was this risk on or risk off? I'd say neither completely. It was a week of rotation. And as traders, that's worth noticing because sometimes the headline index tells you far less than what's happening underneath it. Now, one of the biggest pieces of the puzzle was US inflation. CPI came in slightly softer, with annual inflation easing to 3.4%, while core inflation came down to 2.5%. Then producer prices were unchanged at headline level. And markets like that. The S&P went on to make another record close. But here's where we've got to be careful. It would be very easy to look at those numbers and say, right, inflation's coming down, problem solved. Not quite. Some of the underlying producer price measures were still firm, and at the same time, we've just seen oil jump about 5%. So inflation is still very much part of the conversation. And this is something I keep coming back to. Markets don't trade whether a number looks good or bad. They trade how it compares with expectations and what that changes next. In this case, the question is what it means for the Federal Reserve and interest rates. Then on Friday, we got a different kind of warning. US retail sales unexpectedly fell 0.6%. Now this creates an interesting situation. Recently, weaker economic data has actually been welcomed by markets. Why? Because weaker data can mean less pressure on the Fed to raise rates. But there's a limit to that. At some point, the market stops saying, great, interest rates might stay lower, and starts saying, hang on, is the economy actually slowing down? And I think that's something worth watching over the next few weeks. It's not about predicting a recession or anything dramatic like that. It's simply recognizing that the conversation is starting to change. Here in the UK, the picture was a little brighter. The economy grew 0.4% in the second quarter, helped particularly by services. That's encouraging for growth, but it also makes the Bank of England's job slightly more complicated if inflation remains sticky. And we'll find out more about that next week. But I also want to come back to this idea of rotation. The Russell 2000 outperformed this week, while Amazon, Alphabet, Apple, Microsoft, and Meta all fell from Monday's open to Friday's close. That's important because if you're only looking at the S&P 500, you might completely miss what's happening underneath. Who's actually leading the market? Are small caps strengthening? Is technology weakening? Is participation broadening out? Those questions can tell us far more than simply saying the S&P was up this week. Now, two markets really stand out on this slide. First, crude oil. WTI started around $78, traded above $84, and finished around $82.40. Renewed concerns around Iran and the Strait of Hormuz were a major factor. But even if you never trade oil, you should still pay attention to it, because think about the chain. Oil affects inflation, Inflation affects interest rate expectations. Interest rates affect currencies, bonds, and equities. That's why we talk about understanding the bigger picture. Then we've got USD/JPY, which finished around 159.3, and we're now getting very close to 160 again. You've got the interest rate differential supporting the dollar on one side, and the increasing possibility of Japanese intervention on the other. That's potentially quite an explosive combination. So this is definitely a market where I'd want my risk properly defined before doing anything. Crypto was also interesting this week because it didn't follow equities. Bitcoin fell around 3.4% from Monday's open to Friday's close. Ethereum and XRP were also lower. Meanwhile, US equities were sitting around record territory. And that's a useful reminder about correlations. People often talk about Bitcoin and technology stocks as though they should always move together. They don't. Correlation is useful context. It isn't a trading rule. If the price action is telling you something different, listen to the price action. So what do we actually do with all of this information? This is where we come back to the CLiK process. Before worrying about where a market might go next, where is price on the higher timeframe curve? What's the intermediate trend? Where are the quality supply and demand zones? And if price reaches one of those areas, is there actually enough profit margin to justify the risk? That's the process. Because after a week like this, it's very easy to start chasing. Oil's moved 5%. Oh, I need to get into oil. USD/JPY is approaching 160. I can't miss this. No. If the location isn't right, we wait. Missing a trade costs nothing. Chasing one at the wrong location certainly can. And that brings us nicely into next week because we've got some important events coming up. On Tuesday, we've got UK employment data. Then Wednesday is probably the key day. We've got UK CPI, followed later by the Federal Reserve's July meeting minutes. And those Fed minutes are particularly interesting now. Since that meeting, we've had weaker employment, softer inflation, and weaker retail sales. So we'll be able to compare what policymakers were thinking then with what the market knows now. We've also got Walmart earnings, which I'll be watching less for the headline profit number and more for what management says about the US consumer. And then on Friday, we've got UK retail sales. So there are plenty of potential catalysts. But that doesn't mean we need to trade all of them. It simply means we need to be prepared for them. And that's probably the main message I'd leave you with this week. We've had softer inflation, stronger UK growth, weaker US consumers, surging oil, falling crypto, and US equities still sitting around record levels. Markets rarely give us one neat story, and thankfully, we don't need one. We need a process. Know what's on the calendar, know where your levels are, know what you're prepared to risk, and then let the market come to you. Preparation rather than prediction. Process over emotion. I'm Iftekhar from CLiK Trading. Thanks for watching. Have a good trading week, and I'll see you in the next roundup.